Market's a discounting mechanism. Maybe some of what we're seeing today, as far as the market going down, is anticipating what tariffs are going to do. 72% of companies have reported earnings already. We're up 12.8% on a year-over-year basis for Q1. So great growth, second consecutive quarter of double-digit percentage growth, but we'll see what the last 28%. Obviously, we got some big names in there that still need to report. What we're seeing, though, and maybe this is what's getting priced in, is analysts are cutting expectations for Q2 roughly 2.4% across the board right now. Do you see that kind of being a reason maybe the market's just hanging in this zone that it's in right now?
Well, look, I think if you run screens on the individual names, there is a massive, massive difference between companies that you'd want to buy right now versus the rest of the S&P. And to sit here and say, oh, the S&P is valued at 22 forward or 21 forward is not really doing yourself the benefit of looking at the individual names. And that's what we do at Stenger Family Office is we, obviously you're heavily involved in this. And, I run screens on the S&P. Okay. And I say Microsoft today is trading at 33 PE. You've got NVIDIA here at 38. You've got Google at 18. You've got Amazon at 30. You've got Meta at 23. And these are all companies that have grown sales 10% a year or more the past 5 years. If you screen the S&P by balance sheet quality, meaning not over levered and have grown profits and revenues over the past 5 years like this, there's literally only 78 companies out of 500 that fit the bill.
Yeah.
78. And again, I think this is the problem for people as they look at these analyst cuts, as they look at the entire S&P. Not every company's created equal. Not every company has the same balance sheet. Not every company has the same management team. Just because two companies are airlines, doesn't mean they're managed the same way. Just because two companies fit in the energy sector on XLE, the Spider ETF,
Yep.
doesn't mean they're both managed correctly or the same way. And I think this is where we've added a lot of value. I think this is where being very careful of the quality of companies that you own has really made a difference is by separating the best from the rest. And again, I don't know how you look at the S&P and say, I'd want to own all 500 companies forever. It's only 15% of the index is literally driving most of the quality. Okay. Now, you are paying a premium for high growth names that we've stayed away from, like Palantir. Now, right or wrong, maybe we should have bought Palantir. Maybe we shouldn't have.
Yeah, but that would have been more of a momentum trade. They still haven't proven that they're going to have earnings next year that justify it. I think if you see guys too, right, from a technical standpoint, when they're actually looking at the chart, we're more fundamental and is this a good business and is it going to continue to be a good business?